webinar with me, David Jones, and Aondo Markets. If you're watching the recorded version of this, it was held live on Wednesday, January the 31st at 12:30 in the afternoon. So this is a webinar we do every week on a Wednesday lunchtime. And it splits down into two parts. We take a look at what's going on in the markets, levels to watch, and we'll do a bit on education, a bit on strategy. And this week we'll do, I think it's absolutely the most important thing, and probably the biggest reason why people lose, how much to risk when trading. So we'll do that as usual. Pizza Express next door are just getting their recycling done. So if you hear any beer bottles in the background, that's what that is. So we'll spend a bit of time looking at the risk side. But I think that risk warning's been up long enough now. So let's get into it. I think the pound is one to start with. It's been a heck of a move over the last, I suppose for this month, isn't it? I mean, we've started the year. Where did we finish last year on the pound? Let me just make sure everyone can see that. We finished last year trading. Where's my little crosshairs? There we go. So we finished last year back here at around about 135, and it's touched 143.5 already this year. It was a heck of a move. That's an 800-point move. So more than 5%, I think, isn't it, for when it was up here at the highs. So a big old move. Last year was the worst year for the US dollar since 2003. So it had an incredibly weak year, and we've come into this year with people still very pessimistic about the US dollar. I almost want to be a little bit contrarian there, where everyone thinks it's going to go down again. And I just think, well, maybe it's gone far enough. But clearly this weaker US dollar has helped the pound here. Let's just put some squiggles on as well. Weaker US dollar has definitely helped the pound. A bit more optimism around the old Brexit negotiations is doing its bit as well. Let me just change the settings on this to 533. But I do wonder if maybe for now at least the pound has gone far enough. Don't get me wrong, that trend is definitely still up, pound US dollar. So if we pick up on the trend, maybe from just under a year ago, looking something like that, you can see how overextended it's got from the trend line. A bit like here, it's gone even more overextended than it did in August, September. And what happened then? The market pulled back. So for me, I do sort of favour a pullback here for pound US dollar after such a move, back into that range, that post-Brexit referendum range. So I do think, maybe we've got a little bit overheated pound US dollar. Let's see what happens, but definitely if we drop back down to the sort of mid 130s, 136, 137, 134, that whole area there, massive area of support, if we did see a deeper sell-off. But maybe, I think it's just going to be boring now. I think after all the excitement that we've had in January, maybe we'll have just a bit of sideways trading, which is something I like. I mean, I talked about this a bit in the past. I do sort of options trades, sort of 4 to 5 weeks out on markets, looking at them really going nowhere. And I think maybe the pound could be a good one for February. Let's see what happens. But that big trend's still up, but maybe a little bit overdone in the short term. Let's take a look on the hourlies, because we saw a good reversal yesterday. We saw this market really, really sell off from, it was end of last week, wasn't it? It was a little bit weird last week. We had the US Treasury Secretary come out and saying that a weaker dollar was good for the US. They didn't have a problem with it. It was good for US trade. Then I think President Trump sort of turned that on its head a bit, and the market went a little bit crazy. It was sold off yesterday down towards 139.80, and it's bounced back 180 points. So clearly that there still does appear to be, enough people out there willing to buy into the dips, but does it have enough legs in it, to get up to 145? We'll see what happens. But I think if we saw a bit of weakness, I think tonight we've got the interest rate decision in the US, the Federal Reserve. On Friday, we've got the non-farm payrolls, the US jobs number. So there's plenty out there to cause volatility over the next couple of days, and there's lots of support. I still think this market is going to go higher this year, but in the short term, maybe we'll get some pullback. So 139.80, support 139.20, 138.40. There's so much left by this move higher that I do expect it to snap back quickly if we do see a sell-off, but on the dailies, maybe it's gone a little bit too far for now, and is due some boringness, to use a technical term. But that trend is still definitely up. Let's take a look at euro dollar. Here we go. So last week we had in euro dollar the interest rate decision from the euro last week. No change. But I think Draghi, the president of the European Central Bank, Mr. Draghi, said he didn't see the euro sort of really starting to run away higher from here, but that is what it's been doing, over the last 10 months or so. Anyway, there's our all-time high in the euro set just over a week ago, or just under a week ago. The market's been a little bit sideways since, and like the pound, the trend is definitely still up for the euro. Let's flip it. I think we have seen a major euro reversal over the last 12 months or so now. We built this base from 2015 through to sort of a year ago, and the market started to move higher. There's not much. I think 129 still looks like a good target. So 450 points from here. Over the next maybe few months for the euro against the dollar. But again, maybe a little bit like the pound. It's how much is left in the tank from here. We've got this great recovery trend that's been in place now. That's still very much valid. So I'd still be tempted to be definitely a buyer on dips. For the euro against the dollar. We've got. Let's have a look on the hourlies. We'll see some of these short-term levels. Here we go. Let's take that out. There we go. So we've got lots of levels. We've got left from yesterday, 123.30. Big levels down here, I think, at 121.60. And if the euro takes out those highs at 125, let's call it 125.50. Let's round it up. I think that would be maybe the catalyst for it to move higher. But at the moment, even though I do think this dollar weakness story is getting a little bit overdone, there's no real sign of the euro or the pound about to fall off a cliff. It will be, but I think it's going to be an interesting year. But I just think that maybe people are being a little bit too pessimistic this year about the US dollar. Let's see what happens. So that's that. That's those. Dollar yen was interesting last week. I did have an options trade on dollar yen where I was expecting it to go nowhere, and it did exactly the opposite. So I've taken a loss on that one. But dollar yen was interesting because of the move that we saw. Here we go. So I think this is really interesting. Now, again, if like me, you think, well, maybe it's time for a bit of a dollar recovery. Dollar yen really got clobbered this year. It started the year around about 112. Last week it touched 108 and a bit, so we saw a 400-point move for dollar yen. But look where we are. On dollar yen, April last year, around about 108 were the lows. This is the big level. September last year, 107.30 is the low, and last week it traded to 108.28. So it came within 100 points of that level. So again, I'd suggest, well, if the market's going to rally from anywhere, then it's here in dollar yen. If I was trading it now, where is it now? 108.84. I'd want a stop loss, maybe at 107. Okay, so it's a big old stop loss, 180-point stop loss from here. But if the market's going to recover, we've got maybe 600 points on the upside. So I think dollar yen is an interesting one down at these levels. Also, for the fans of the squiggles, look what's going on down here. So this is what is this? I've forgotten. 5-day stochastic. So 5-day stochastic, understandably gone oversold with a big sell-off. Market hits a low, rallies, pushes a bit lower still. But look what these stochastics are doing. So we've got higher lows on the stochastic. So this is known as bullish divergence. So the market hits a low, pushes a bit lower, but our stochastics are making higher lows. Traditionally, this is the sign, again, adds extra confirmation that maybe it's a market that's got a bit pushed too much to the downside. So I think a bit like here, it took a while to play out back here. It took a long time to play out, actually. August hits a low, stochastic is making a higher low, pushes lower again, and stochastic's making higher lows. It's a bit of a messy one, but that sort of thing, where the market's pushing lower, but our little squiggles are maybe telling a different story, that momentum is fading. But I think dollar yen is interesting down here. It was really nosediving about a week ago. But if it's going to turn around anywhere, maybe this is the place. So I think it's an interesting one to watch. But euro dollar, pound dollar, still strong, but maybe a little bit overheated in the short to medium term. Should we just do a bit on Bitcoin? I mean, I am fascinated by the cryptocurrencies. It's been over the last week. There's been a lot of negative stories. We've had there was the hacking in a Japanese exchange last week, where $500 million apparently went walkabout. Then we had that story last week in the UK in the Midsummer Murders Village, wasn't it, where the chap was had an armed robbery and forced to transfer his Bitcoin over to someone else, the robbers. Why is that doing that? Then we had yesterday, I think Facebook have said they're going to stop taking adverts for Bitcoin and dodgy stuff like some of these flaky binary options type products. And then we had the US CFTC, whatever it is, the US regulator, one of the US regulators, announcing an investigation into Bitfinex, one of the exchanges. So it's been really negative. But saying all that, the price has held up pretty well, I think. Clearly, if you bought just before Christmas, you're not too happy because it's halved since then. I think definitely a lot of the mania has left it now. The Bitcoin, I think we've got much more of maybe a normal market. But I think it's interesting down where it is. Even though we've had a week of pretty bad news, it's not been clobbered too much. I think it's interesting down here, if you're a fan of the crazy cryptos, down at these sort of levels, where we sort of spiked lower on the way up, comes back down to it. This sort of 9,000 mark is an interesting one. So it's currently at what 10.3-ish is where it's trading now. If the Bitcoin is going to bounce from anywhere, I think this is the level. So it'd be an interesting one to watch. I think down here, I must admit, I did buy it. My son came back from college last week and said, "We've learned all about this thing called Bitcoin, Dad. Did you know what it is?" And I'm like, "Oh, don't you know what I do for a living?" But so I thought we'd buy it to give him some exposure, a little bit, a tenth of a Bitcoin, to give him some exposure to the volatility. But I think if that 9,000 level goes, I think maybe we'll see a much deeper sell-off, but it'll be an interesting one to watch, I think. Let's go back to more normal markets. Actually, let's do the little strategy bit. Let's talk about this risk bit. Let me just try and flip my screen around a little bit. I can't stress enough how important what I'm going to talk about now is. I used to work in the spread betting industry sort of full time from 2005 to 2000 and end of 2013, and I still do a lot now, stuff like this. And I think it's the biggest reason why people lose money is risk. They trade too big, however much money they've got, they trade too big, and you still see it all the time. So how much should you trade? And it's really easy. If I make them round numbers, let's talk about pounds, let's talk about dollars. If I make it round numbers, there's a lot of informed wisdom that's been out there for this for years. Let's say you've got a £10,000 account. The first basic bit of money management is how much do you risk on any one individual trade, whether it's gold or euro dollar or Bitcoin or something else. How much do you risk on any trade? And most sensible approaches suggest you should risk somewhere in the region of 1 to 3%, risk losing 1 to 3% on any one trade. That doesn't mean you place a 3% stop loss. What it means is it's completely separate to figuring out where your stop loss goes in the trade. What it means is if you've got, in this example, 10 grand and you want to risk 3%, it means if any trade goes wrong, it only loses you 300 quid. Yeah. So let's say, for example, you wanted to buy some shares in Barclays. So you buy shares in Barclays, you decide you're going to have a 10% stop loss on the shares. So if you're only allowed to lose 300 quid, you buy 3 grand's worth of shares in Barclays. Okay, so your position size is 3 grand, which is 30% of your trading pot. Your stop is 10% away. You're only risking 300 quid, which is your 3%. Now, the reality is people do not like hearing this, and I know this from my experience, I think to speaking to thousands of clients over the years. People don't like hearing it because there are a couple of reasons. First of all, actually, let's just delete all that. First of all, the average account isn't £10,000. Let's say the average account is £1,000, and we're going to utilize this, this 1 to 3% idea. So we're going to go with 3% again. It means any trade I do, I'm only allowed to risk losing, if I've got a £1,000 account, 30 quid. in this example. So if I'm going to buy Barclays with a 10% stop loss, I'm only allowed to buy £300 worth of Barclays. And the problem is, of course, plenty of people come to trading thinking it's a license to print money, and the reality is, of course, it isn't, because most people lose. And they think, well, hang on a second, if I'm only trading this sort of size, it's going to take me ages to turn my £1,000 into £10 million. So they end up taking on far too much risk, and I'm sure we've all seen the examples. If you have a £1,000 account, and let's say you risk losing 500 quid on a can't lose trade, and lo and behold, it does lose, your account is now 500 quid. Yeah, so you need to have 100% return on your 500 quid now to get back, to where you started. And it really, people shoot themselves in the foot with this, because they want to see decent gains. And if you're going to make decent gains, clearly you have to take risk, but it's all about how much risk you take. And I think this really is the reason why people blow their accounts up. I don't think, or in my experience anyway, it's very rare that people will blow their account up on one trade, unless it is a crazy market like the cryptocurrencies were in December and early January. But I think where they do it is just trade. It's a series of just maybe risking 10, 15, 20% of their account. You have 5 trades that go wrong and your account's gone. So this is the most important thing to do. If your account value is X, what percentage of X do I risk on each trade? Yeah, and it's something I would suggest you ask yourself. And like I say, most sensible approaches as a financial amount, 1 to 3%. Yeah, it means you get rich slow, assuming you've got a profitable approach to the markets. But you stay in the game when things go wrong, and it means that any one position doesn't really stress you out if it goes on. Like my dollar yen trade that I got clobbered out of last week. It's not the end of the world that one trade lost money, because it's only cost me a couple of percent of my account, and hopefully all my fantastic winning trades like the pound this month will more than make up for that. But really give some thought to it. People don't give any thought to it, they jump straight in, and that's I think a big reason why lots of people are losers when it comes to trading, because they don't think about the risk. Okay, how about the gate system? Never heard of it. Only use the compounded number. I don't know, never heard of that. That's a question that's come in. For me, I just keep it simple really, and just do it that way as a percentage of my account size. Right, so let's go back to the markets. Let's talk about stock markets. Brace yourselves, we have had 2 whole days of falling markets in the USA. What is the world coming to? I think I saw it on Twitter. I think there was a headline in the Express or something today. The Dow was down. Is this the start of the crash? I think someone put it on Twitter. You think, what? This is the S&P, but clearly the principle is the same. The market sold off for 2 days. So that's it. Sell everything. We are going to the basement. It's a welcome bit of volatility. I can't even say that word, volatility, that's come back into markets, because it has been pretty dull. So this is the S&P 500, the market that normally just goes up every day, but hasn't in the last couple of days. And I think it's interesting. I think it's much better, I think, to have a bit of volatility in that. But it hasn't changed that overall trend. And since it feels like since the beginning of time, but for a long time now. Weakness has only been a buying opportunity. We've been conditioned to buy the dips, and it's something that's done very well if that's been your approach. And at the moment, there's nothing to suggest, I don't think, that this time is going to be any different. But let's look at some levels to watch. So this is a daily chart we're looking at, like I said. And you can see already in the overnight market, even though we've got just over an hour and a half. An hour and a half to the market opens. We're already seeing a bit of strength coming in. But let's take a look on the hourly chart. Here we go. So what's interesting, if you're a chart geek, it did yesterday. It did lose a big level yesterday. The 28-24 on the S&P. It had been the low over the last few days. And you can see it sort of just kept spiking below it. So I'd say, maybe the aggressive trade here, if you believe that, once again, after this little shakeout, markets are going to be off to the races and up we go. I think the aggressive trades is either to be a buyer now, wherever it is, 28.35, with a stop loss under that extreme from yesterday, And so that'd be 18 points of risk. If it goes back up to just the highs, it's 45 points upside, and if it goes higher, clearly more profit. So I think that's interesting. So I think for today, let's see how it reacts if it starts selling off towards yesterday's low. So I think even though it's been quite a dramatic move, it's actually not a dramatic move, but it is, in terms of what we've been experiencing lately. It doesn't really change that overall bigger picture. I think, if we lost that low yesterday, as ridiculous as it sounds, it would be down 3 days on the trot. That could inject a bit of panic into people. It shouldn't, but it's been so long, or it feels so long since we've had anything like that, that maybe we could see, a bit of more momentum pick up on the downside. But for now, it's 2 days out of a market that's gone up for the last, 9 years. So I think it's going to bounce back, but let's see what happens. And of course, maybe we'll have a quiet day today because we've got that Fed decision later on today. So maybe it'll be a quiet start, but I, for one, will be watching those lows from yesterday on that. Let's take a look at some markets closer to home. Let's have a quick look at the DAX, see what's going on there. I must admit, I never look at this during the week, but pretty boring. There's a daily chart. It's in the middle of the range, the DAX, isn't it? Again, I'd say it's clearly in an uptrend. Like all these stock markets, it's in an uptrend at the moment, which means I'm sure that most people are betting against it going up. Another reason why people lose, they can't go with the trend. But it's just trapped in the range. It punched out. It has set fresh all-time highs in January. It's moved out to all-time highs. Support down here ahead of 12.7, resistance up there 13.6ish, and it's almost slap bang in the middle. So it's pretty boring, that one. But let's take a look at the FTSE. I wonder what the FTSE's been up to. Actually, I think it has been understandably under pressure. There we go. It does seem to fall harder than it goes up. The FTSE, it seems to take forever to actually go anywhere. But this is the third week in a row the FTSE's been falling, and of course, it is being compounded by what we've seen with the pound. I know I say this all the time, but with all these international companies in the FTSE, if the pound is strong, then it affects their profits because they make most of their money overseas. So weaker FTSE, still a big down move yesterday. But again, if we do get a bit of strength in the S&P and the US stock markets, that is going to drag the FTSE up. So I think I'd be in no hurry to buy it if I was trading the FTSE. But I suppose it's interesting because we're back in the area for the FTSE, of the old highs, the highs from last year that really trapped it, around about 7,600. So if you thought that was an important area, again, an aggressive trade would be, it's not what I would do, but a stop loss under yesterday's low. So yesterday's low is, 75.67. The market's 75.84. It's only 20 points away. Let's see what happens. But clearly it just depends on how US markets are this afternoon. So interesting. I think stock market's got a bit more interesting over the last few days, a bit more swinging around, which is what we like to see. And let's look at gold. Gold is really interesting at the moment. Again, if you are a massive chart geek, it's for me, I think it's the only chart that matters on gold is that sort of view. Let me just drag it across. Here we go. So this is, I don't know why my scale has disappeared. Hang on a second. Let me try and, my scale has disappeared off the bottom. It's a task. There we go. That's better. So what we have here, this is the July high, July 2016 high. So which was what, $1,375. Then we have the September 2017 high, which was 1357. Last week it hit 1366. So we've got this whole zone from 57 through to 75. That's been a real problem for gold. So if the price of gold was going to run out of steam anywhere, then it's here. This is the place. This is the place that has held this market down for the last 18 months. So again, it does tie in, I suppose, with my bias towards the dollar, expecting the dollar to come back. That if the dollar strengthens, the price of gold is going to go down. But this weekly candle, only this week it started turning around. But I think it's a really interesting area to watch. I think if it breaks, we've got the classic chart. excuse me, classic chart breakout. If we break 1375, we're looking at maybe these old highs from September 2013, around about 1430. Yeah, I think at the moment, if I really had to do a trade on gold, I would be tempted to be short with a stop above those highs. Again, it's going to be like a $30 or $40 stop from here, but it's risen about $120 just in the last month. So it's an interesting one to watch. That we also have, when we were looking on dollar yen, we had that bullish divergence. We've got the opposite going on with gold now on a daily chart. We have bearish divergence. The market's pushed higher and then higher, then higher, but our stochastics are falling away. So I think it's interesting. It's interesting up here. I think, you know, that trend is still up, so I wouldn't be in a hurry. I don't think it's going to fall off a cliff this afternoon. But I think it's interesting that it's moved back to what has been such a big problem area. Gold, that's the 1375 is a big level to watch. And finally, oil. So you know, again, we've seen a big break on oil this year. You know, it's after a bit of a weird year last year. You know, it really got a move on from the summer. Price of oil is up about 50% since the summer. That trend, you know, I think is pretty much untouched. You know, so for now, any weakness like we've seen the last couple of days in oil, you know, it's come off from 66.5 down to 64 a barrel. Any weakness looks like a buying opportunity. You could argue that there's even an opportunity now. If you flip this over to the hourlies, you know, we're pulling back to, here we go. It's quite a big level on the short-term chart, you know, about 62.70-ish. So 62.70, $63 a barrel. You know, it was big support on the way up just before the kick out to multi-year highs again. So again, if you were really bullish on oil, there's an argument to be a buyer down here. We've got the oil inventories this afternoon. It's always every Wednesday, and that's a big release. So again, we can often see quite a bit of volatility. So maybe wait till that's out of the way. But you know, the trend in oil hasn't changed. And the trend is still up. And if we flip it back to the daily chart, you know, for my money, it's only if it dips below sort of $60, $59, that sort of area, does that trend look to be in trouble. So I think the bias for the price of oil still seems to be most definitely up. So we'll see what happens. Right, we will, if I can find my slides, wrap things up there. So I think there's a lot to watch. You know, we've got this Fed thing tonight. We've got the payrolls on Friday. I think the interesting thing to watch is going to be the stock market. You know, even though, you know, falling for 2 days should be nothing, I think it's quite interesting because we have had markets that just go up all the time. So I think, yeah, quite interesting to see how US stock markets perform over the next couple of days and longer term. You know, just keeping an eye on that big level in gold as well. So we'll see what the next week brings. Plenty to watch out for. Any questions, you can drop me an email, david@tradeafter.com. I blog a bit about social trading, although I haven't for 6 months. So I will start again, and you can read sort of various bits, thoughts over the years on my website, jonesthemarkets.com. And on Twitter, it's @jonesthemarkets for charts and stuff during the day. Okay, thanks for coming along. We'll wrap it up there. And I hope you will make lots of money over the next week, and we'll do it again next Wednesday.